The banks are kind of leading indicators of the economy. They're telling us, they're signaling to us that something's not right.
Hi, welcome to the Red to Black podcast. Here, you will learn how to invest in highly profitable private businesses to create abundant financial freedom. If this topic interests you, we invite you to subscribe to our channel. This podcast is hosted by Werner Minchel, ex-Marine aviator and current real estate investor, and Mario Parzino, current Marine infantry officer and business investor. Good afternoon. This is the Red to Black podcast with your market update with your hosts Werner and Mario. And today we're discussing Wells Fargo freezing their lines of credit. Mario, what are your thoughts on that?
Yeah, it's interesting that the banks are kind of leading indicators of the economy. They're telling us, they're signaling to us that something's not right. They're saying we can't make money. Obviously, they're not doing that because they think there is a good risk profile out there for them to lend lines of credit to people, for them to do various things into the economy. They're saying that the rewards don't relate to the risks, or the rewards aren't worth it for the risks they're taking. They're signaling to us something is wrong with the economy. I would also say that interest rates are why the banks are so upset. The banks are not lending. You've experienced this in your real estate business. We've both experienced this through our research, is the banks are not aggressively lending because the interest rates are so low. There's a lot of risks out in the economy, and the reward they have, it's such minuscule return on that risk that it's really difficult to get a loan right now. So I think Wells Fargo is signaling to us that there is dangers in the economy. There's risks that they are not willing to underwrite. They're not going to take that risk on their books. And I think this goes back to 2019, Warner. If you look at the fall of 2019, the Fed had to step in because the repo market, the repurchasing agreements, the banks didn't trust each other, and it spiked. They went from a couple of percentage points up to 10 or 15 percentage points in what they were charging each other to lend, and the Fed had to step in and enter the repo markets to stabilize rates. So these are all indicators of something is sick in the economy. There's a problem with the economy. Over to you, Warner.
Looking at the underlying metrics, fundamentals of a business, and a bank is a business like anything else. Now, we're not the biggest fans of banks because they've lent out most of their money. They don't have a lot of reserves. But the bank is a business like anyone else, and they have certain options they can do with that cash. Because read on Zero Hedge, they have the discount rate, right, which is where they'll they'll borrow money from the Federal Reserve. But most banks don't want to do that because it's taboo. They don't want to borrow that money. So that's not really an option for most banks. Number two, they make money a little spread off of their reserve accounts that they keep at the Fed. They're required to keep there. So they're not making a lot because, as we know, the 20-year note or the 30-year note is at around, last time I checked, was at around 2%. So now the banks are going out saying they're going to lend into the market, and they're not only looking at, as you said, low interest rates, they're also looking at the viability of businesses in the market, and they're not seeing what probably most banks or businesses want to see is consistency and a persistent environment. So what that's telling us, what we think that's telling us, as you've said, they're freezing these lines of credit because they're tightening up their ship. That is a huge, huge, huge statement that a lot of people are talking about, but I think a lot of investors aren't getting the severity of the situation. One of the largest banks in the country just said,
in the world.
In the world. Okay, exactly. They just said, we are tightening up ship. So what does that mean for us as investors who are looking at buying or starting highly profitable businesses, or even investing? It's not just starting highly profitable businesses, buying highly profitable businesses, or buying businesses in the publicly traded markets. What's the warning for all of us investors sitting out here?
Well, on almost any metric that you look at right now, Warner, things are fully priced or overvalued in the markets. Anything, whether it's a private business, publicly traded business, any type of real estate, etc., it's either fully priced or overvalued on any metric. And it's, in fact, some metrics are signaling that this is one of the largest overvaluations in history. If you pick a certain metric to look at, the banks, this is what the banks are signaling, is that something is wrong with the economy and that there's not a good risk profile for them. At the end of the day, they lend money to make money. And there's a few people right now that they're willing to lend to, and they're really corporations or like guys that have a very diverse portfolio of businesses or real estate. They'll lend on that. We talk about this character, let's just say Benedict Canyon guy, who's got north of like $150 million worth of real estate. He has a line of credit to go out there and do $8 million deals for cash, quote unquote cash, because he has a revolving line of credit. And they probably still haven't pulled his credit because he's a corporate client. He's running a business, but an individual, a mom and pop, can't go out there and get 800 grand or $80,000 from Wells Fargo because the risk, the bank is no longer lending to those folks. So it's signaling that the economy is not healthy. It's not strong enough that the bank is optimistic about lending their cash or the reserves they have to into the economy, and that's crashing the economy. The banks will crash the economy if that continues, or if that becomes a trend. The banks will crash the economy by not creating bank loans. That's how most of our dollars are created in the system. The debt system is through more debt. So if people are paying off debts, that's contracting the monetary supply. If all of this happening, not enough debt is being issued, and debt's just being paid back, that's a contraction in the monetary supply. The monetary system is contracting. It's not expanding. For this economy to work well, for people to be able to sell things, their house, for more than they paid for it, for a piece of real estate, etc., the monetary system needs to expand. Debt needs to be continually issued and expanding for our system to be growing. If it's contracting, our economy is contracting, the goods and services we're producing are contracting, it's nasty. Those are my thoughts on Wells Fargo's contraction of lending to individuals.
Yeah, here's the challenge of what you were saying, and you were kind of reiterating what I was saying is they're tightening, or you actually went a little bit more into depth. They're tightening up the lending to smaller players. And that's a trend we seem to be seeing nowadays. They cut off the smaller businesses, didn't allow them to do business, which is a travesty.
I don't think they're doing. Most banks are not doing small business loans anymore.
Oh,
They've
so where do you think that but those lines of credit, I mean, we're talking maybe, I don't know, few hundred thousand to maybe $1 million or less. Were those going to the smaller players? That's what I assumed. Or are they going to larger
Yeah.
players that they just cut
No,
off?
that's mostly for smaller players. I mean, that can be inventory, working capital. It can float you through a time until you have another deal. It can keep your business. Yeah, these are revolving lines of credit that people use in business to basically bridge through different cycles in their business. So inventory comes in, they need a bridge before they can sell that. Sometimes a business has to offer 30 days same as cash to get their product into a retailer. Well, they need working capital to bridge that 30 days. They're going to get paid once the 30 days crosses over, unless they can't collect. But yeah,
Here's the challenge. Our economy, like you said, is so addicted to debt. I mean, me included, being in the real estate world and transitioning out now to the podcast world. The world, especially the US, is addicted to debt. And what I mean by that, when you look at a great business like Oracle, they don't need debt. You go down through their cash flow statement, as we talked about in our last episode number 16. They don't need debt. They have enough cash to go out and do acquisitions, investing in marketable securities, reinvesting in their own business. They don't need the debt. But most small businesses, they haven't trained themselves to set up their business as a cash business, meaning they make a little bit and then they save some of the cash and they take the rest of the cash and they deploy it into going bigger, buy more products, buy more services. They're all addicted to these lines of credit. So when that all contracts, it's going to have a real nasty effect on the economy. And what it's going to create is an environment where, like you always say, a lot of people have gone out over their skis And now they're going, oh man, I went too far out and now I'm tumbling and falling. And for guys like you and me, we're waiting for that moment, not in a negative manner. It's just, hey, this business, you went out over your skis. Now there's a business we could buy. Let's execute on it because it's selling at a great price and it's an underlying business. It was just run poorly. They over leveraged it. So I would say those are the opportunities with what's coming, and what we're being shown is they're tightening up their ship. And that tightening of that ship, if it keeps going, as you said, is going to create a bunch of network effects. And we're just talking about like one network effect. We have no idea the multitude effects of all the other effects it's going to create. That's what's going to get real interesting.
2 points to add, Warner, is number one, it's not just small businesses that use debt. It's virtually every business is using debt.
Yeah, exactly.
It's
exactly.
very few. The Oracles of the world, there's very few businesses that are drowning in cash, or they have enough cash that they don't need debt. You're right. You're correct. Oracle is one of those unicorns that is able to generate enough cash through operations.
It's not called a unicorn. Funny enough.
Should be. It's a rare business that does that. Most, not only small businesses, medium-sized business, and large businesses, most are operating off of enormous amounts of debt, and it's a debt game they're playing. And if they're really smart and they're really shrewd, they can play the debt game for a long time. Second point is, when you start having contractions at that level of, there's a lot of banks that don't have the analytical ability that Wells Fargo has. So they're just going to mirror what they're basically looking at the lead horse, and they're saying, oh, the lead horse just changed its stride. We're going to change our stride. Not because we know exactly what they know, it's just because we have to respond that way, because we'll get crushed if we're off. We're out of step. So by Wells Fargo contracting, a lot of other banks, a lot of other lenders are just going to follow their play. They're like, they're a big bank. They know what they're doing. They've been around a long time. If we want to survive, we can't get out of step. Very few banks are going to go, oh no, I don't think Wells Fargo knows what they're talking about. Our analytical abilities are better than Wells Fargo's. We'll keep lending to these kind of players. Again, and it's a waterfall, or it's a dominoes of, once that contraction happens at Wells Fargo, then JP Morgan, then Bank of America, then Citibank, then all these banks start contracting, and then all the smaller, the like, let's say tier 2 banks, tier 3 banks, regional banks, like state banks, local banks, it's ugly. This is going to be, this could start a very destructive process in the economy, where you have contracting lending, and the Fed can't control it. It's out of the Fed's control. The Fed can't force a bank to lend. They can keep putting reserves on their account, and the banks can keep putting it back at the Fed and getting a little spread, like you said. But they're not making very much money off that. The way a bank makes money is by lending, is creating new loans, is taking in deposits and making money on those deposits, lending into the economy, finding deals that makes sense, that the bank likes. It's like, go do a real estate deal right now. It's like, it's all bridge loans. Like, very few real estate deals do the banks actually like, and they're big, huge properties in major cities, and with a track record, with a business with a huge track record. So it's going to get nasty, folks.
Yeah, great points, Mar. I think that's enough for our market update on these lines of credit being closed. We'd like to thank our listeners for listening. Please hit the subscribe button if you like our content, and we look forward to speaking with you in the future. Thank you for listening to the Red to Black podcast. We really appreciate you taking time out of your day to listen to our podcast. If you would like to connect with us in the future, you can find us on LinkedIn. Simply search for Werner Minchel or Mario Parzino. Also, you can find a link to our LinkedIn profiles in the profile section of the podcast. Thank you again for listening, and we look forward to connecting with you in the future.